Welcome to my video, and in this video we are going to discuss about personal income tax. So personal income tax is about taxation of individual income. So the law we are using the Rwandan tax law. So this video is important to students that are doing their CPA exams, specifically advanced taxation, that is A2.3, and foundation taxation, which is F2.4. So in this chapter, we are going to look at introduction to personal income tax. We shall look at taxation of investment income, taxation of employment income, and taxation of business income. So let's look at our first part, that is the introduction to personal income tax. As I said in my introduction, that personal income tax is about taxation of individual income. And when we are taxing the individual income, it's very important to know the residence of the individual. Why is it important to know the residence of an individual? Is that the residence of individual has got an implication, or it has got a consequence on how we compute tax and the tax base. So the question is, who is a resident individual? So the tax law provides that a resident individual is the one who meets one of the following conditions. So he can meet either 1, either 2 or 3, or he can meet number 4. That person is going to be considered as the resident individual. So the first one is the resident individual is the one that has got a permanent residence in Rwanda. So if an individual has a permanent residence in Rwanda, automatically that individual qualifies to be a resident. Number 2, if the individual has got an habitual abode in Rwanda. So if he has an habitual abode in Rwanda, automatically he qualifies to be a resident. Number 3 is if he is the Rwandan who represents Rwanda abroad. So the Rwandan diplomats abroad, as far as taxation is concerned, they are taxed in Rwanda. Then we have an individual who stays in Rwanda for more than 183 days. So you have an individual who has stayed in Rwanda for more than 183 days. In that case, that individual is going to be considered a resident as far as tax is concerned. So when we are talking about 183 days, it does not mean that you consecutively stay 183 days in the country. So what it means here is that an individual can stay, maybe for example 50 days, he goes, he comes, he stays 60 days, he goes, he comes, he stays 100 days. So if we compute in a given tax period that the individual has stayed for 183 days in that tax period, so automatically that individual is going to be considered a resident for that tax period. So what is the tax consequence or tax implication of a residence? So if an individual is a resident in Rwanda, that individual is taxed on the income generated in Rwanda and the income generated outside Rwanda. So that's why I say if he's a resident individual, we look at the income you have gained while you were in Rwanda and the income that you gained outside Rwanda. So that we add that income together and then we calculate a tax on the both incomes. However, if he's a non-resident is only taxed on the income generated in Rwanda. We don't look at the income generated outside Rwanda. Another important issue is how we compute tax. For resident, we compute tax, we are looking at resident individual. So if he's a resident individual, we compute tax under the personal income tax. So we are going to look at that. For non-resident, we compute tax on withholding. So we only look at the withholding tax for a non-resident. So the base for calculation of personal income tax, we have the employment income, we have business activities, investment, the capital gain on on shares or immovable property, sale, use or lease of or transfer of immovable property and the immovable property. So those are the different bases on which you can compute the capital. You can compute the personal income. The tax rate for personal income tax, we tax in bands. From 0 to 360, it is 0%. There is no tax. From 360 to 1.2, we tax 20%, and from 1.2 and above, we tax 30%. So we add the total then to get the taxable income. I mean the total tax. So let's look at how to tax the micro and small business. When you talk of micro businesses are those businesses whose turnover ranges from 2 million to 12 million. So if the turnover is between 2 million to 12 million, then that business is considered as a micro business. So when we are taxing micro business, we tax based on the turnover. And our computation or our tax will be from 2 million to 4 million, the tax is 60. From 4 million to 7 million, the tax is 120. From 7 million to 10 million, the tax is 210. From 10 million to 12 million, the tax is 300,000. So meaning in a small and a micro business, we tax under what we call a lump sum tax. And when we talk of a lump sum tax, we mean that the tax is calculated on the turnover. If we say a real tax, the tax is calculated based on profit. So for small and micro business, they are under a lump sum tax regime. So for smaller business, we've said a smaller business is that business where the turnover or the annual turnover is between 12 million to 20 million. So that one is classified as a smaller business. And when we are taxing, we calculate 3% on the turnover. So as long as your turnover is above 12 million, but up to 20 million, then that business is classified as a small business. However, for a smaller business, it can apply to move from lump sum tax to real tax. However, the issue is that if a small business has applied to move from a lump sum tax to a real tax, then it must apply through the Commissioner General. And if the permission is granted, it cannot move back unless 3 years has elapsed or has ended. So you cannot move from a lump sum tax this year to a real tax, then the next year you go back to a lump sum tax. No. To change again, 3 years must have passed. Before 3 years, it cannot change back to a lump sum tax. So let's look at the taxation of investment income. When it comes to investment income, we mean income, any payment in cash or any payment in kind in the form of financial interest, dividend, gain on shares, royalty, rent, which are not taxed under business income, then we consider them under investment income. So let's look at the gain on shares. When it comes to the gain on shares, we look at the difference between the proceeds from the sale of shares or the proceeds from the transfer of the shares, then minus the cost of the shares. So that gain on shares, we calculate a tax at a rate of 5%. I said when we are calculating the capital gain on shares, we look at the proceeds from the sale of the shares or the proceeds from the value of the share. That's when if the shares have been transferred, then we less the cost. That's the value at which the shares were purchased. Then we get what we call the capital gain. So the capital gain tax is calculated at a rate of 5%. So this is a simple example on how to calculate the capital gain. You have this total number of shares that were purchased. in a private company in 2010. Then in 2018, 50,000 shares were sold at this per share. So how do we compute the capital gain? Remember I said you get the proceeds from the sale of your share minus the cost. So the shares were sold at 300. So we are going to get the 50,000 shares, that's the number of shares which were sold, times 300. Then we get our proceeds from the sale of the share. Then minus our cost, which were, remember the share were purchased at 200. So we get 50,000 times 200. Then we get the cost of the share. Then our capital gain will be the proceeds minus the cost. We get our capital gain. So to get the capital gain tax, we get the capital gain tax rate, which is 5%, then times 500, then we get our capital gain tax. So when do we declare the capital gain tax on shares? So the capital gain tax on shares is declared 15 days after the end of the month from which the withholding was made. For example, if the withholding is made in this month of May, then 15 days in the month of the June, you must declare a capital gain tax. So exemption. So the capital gain on shares which are traded in the secondary market in the Rwanda Stock Exchange is exempted. So if the shares are being traded in the secondary market in the Rwanda Stock Exchange, the gain on those shares is exempted from the capital gain tax. For example, for now shares that are, for example, if you have shares from BK, Bank of Kigali, and you are now trading them in the secondary market through Rwanda Stock Exchange, then the gain you are getting from those shares is exempted from the capital gain tax. So another exemption is on collective investment schemes. For example, you are employees of a given company, you invested in shares of a given company, and now you are selling those shares as a collective investment. In that case, the gain you are getting from that is also exempted from the capital gain tax. So another investment income is the financial income. So the financial income, we have interest income from the loans, we have income from the deposits, income from guarantee, income from government securities, that is income from bonds, negotiable securities issued by the government, securities issued by public and private companies like debentures and commercial papers and what. We also have income from cash negotiable securities. So this interest income on these securities is also subject to tax or is under financial income. So how do we tax? So the tax rate is calculated at a rate of 15% exclusive of VAT. So if it is inclusive of VAT, you need to first get an exclusive figure. And then after getting the exclusive figure, you calculate 15% of that value. It's going to be, then it will be the tax on those financial income. However, there is an exception on financial income or on the interest income. If it is financial income from or interest income on a government bond or a government security that has got a maturity period which is 3 years and above, then we are calculating at a rate of 5%. If it is below 3 years, then the tax is normal 15%. But for government securities that have got a maturity period that is 3 years and above, then we are calculating at a rate of 5%. So we also have some interest income that is exempted from withholding tax. So the interest income on deposit in financial institutions for at least a period of 1 year. So if you have invested, for example, in a fixed deposit and your fixed deposit is 2 years or it is or 15 months or 1 year, 12 months, the interest income that you get on those deposit is exempted. However, if it is below 12 months, then you pay tax. If it is above 12 months or 12 months and above, then the interest income will be exempted from tax. Another one is interest income on loan granted by foreign development financial institutions. For example, the IMF, the World Bank. So the interest income on those foreign development financial institutions, the development banks, African Development Bank. So that interest income is exempted from the withholding. You don't withhold tax. Another one is interest paid by banks operating in Rwanda to banks or to other foreign banks. For example, KCB can give a loan to Beka, and then it charges an interest on that loan. So the loan that is given by KCB to Beka, or Beka to KCB, or to Beka to Equity, that interest is exempted from interest or tax. So another investment income is the dividend income. The dividend, that is an income on holding shares in a given company. So dividend is also taxed at a rate of 15%. However, the dividend income on shares which are traded on Rwanda Stock Exchange market is taxed at 5%. And the issue that those shares must be owned by a resident of East Africa. So if the shares are owned by a resident of East Africa and they are traded in the capital market or through Rwanda Stock Exchange, then the tax is calculated at 5%. So any other dividend or dividend from a private company, then you are calculating the tax at 15%. So another income is royalty income. Royalty income, it comes from payment in kind received from price, use of a right, copyright, literacy, craftsmanship, scientific work, cinematography, films, tapes, televisions, broadcasting. Those are under royalties. We also have payment received on trademark, design, model, computer application. That is also under royalties. So royalty also includes the price for using a right for use of industrial, commercial, scientific equipment, using information concerning industrial, commercial, or scientific knowledge. It is also under royalties. Also payment for use of a natural resource. For example, if you are given permission to mine certain mineral, then that one, the payment you make is also under royalties. So the tax on royalty is 15%. So you get the amount that the person is paying, and then you calculate 15% of that amount. That is going to be the tax on royalties. So we also have what we call the rental income. We shall look at because we also have rental income which is under decentralized, and the rental income which is under direct tax. So the rental income that is under direct tax is the rental income from rent of equipment, machines, agricultural equipment, agricultural tools, livestock equipment. Those are under direct tax. When it comes to rental income in a decentralized tax, we shall discuss that one. We shall have a video on rental income on decentralized tax. It is rental income on an immovable property of an individual. For example, building, rent of land. Those one are immovable property of an individual, and we tax them under a decentralized tax. We shall discuss that one in another video. So when we are calculating the tax base of rental income on from this one we have talked about, rent of machine, rent of equipment, specifically I can say rent of movable property or rent of building that are incorporated, then those one we get the gross rental income. So on our gross rental income, so when we are computing the taxable rental income, we get our gross rental income, the one we have received, we less allowable expense. In this case, the allowable expense will be 10% of our gross rental income. Then we also consider the depreciation of asset, which we calculate based on our tax depreciation rates, which I shall discuss in our business income. Then we also look at the interest expense. In case this asset was financed by a loan and you have evidence showing that you are paying the loan, then in that case we raise the interest expense. So then we get the taxable rental income. So on this taxable rental income, if we are dealing with the individual, like the one we are dealing with, if you are dealing with the individual assets, then we are going to apply our personal income tax rate, the one we discussed in our previous slides. If it is a company, which we shall see in our later slides, you are going to apply the corporate income tax rate. So this is how we compute the rental income or the taxable rental income for investment income. So we shall discuss how to compute the taxable rental income which is under decentralized tax in our later videos. So let's look at this example that can help us to understand what we have talked about. So we have our Mahoro owns machine which she rents to various entrepreneurs. So this is an individual. Automatically when you see our Mahoro, you are not seeing limited. You are seeing our Mahoro, meaning this is an individual. During the year ended this period, she received the gross income of this. This is the income that was received. You can analyze this. This is our annual income. The machine we have purchased at a cost of 45. This was the purchase cost of the machine, of which 20 million is a loan. The 20 million of the 45 is a loan from the bank. You need to look at that. So this is a loan from the bank, and it pays interest. So this is the interest rate that is being paid on this loan annually. Oamaro pays quarterly installment. So she made a quarterly installment for this business of 300. So the question is, what is the taxable rental income and the tax liability to be paid, or the tax to be paid on this rental income? So if we are computing, so remember our pro forma that we have said, we have looked at in our previous slide. We are getting our gross rental income, which is 34 million, and we said we less the allowable expense, and in this case the allowable expense is 10% of 34 million, which you get 3.4. So if we less here, we get 30,600,000. We also consider depreciation. In this case, we shall discuss depreciation, the laws that relate to depreciation. But these are movable assets, or these are machines which are not heavy industrial machine. So when we are calculating, we calculate for 25%. But we shall discuss more on this one in our later videos on how to the laws that relates to depreciation. So if we calculate 25% of 45, you get 11,250,000. We also consider interest because they told us that the machine we are purchased using a loan of 20 million, and there is evidence for the interest. So since there is evidence for the interest, please, that's very important. We only consider the interest expense if you have an evidence that you are paying an interest. If you don't have evidence that you are paying an interest, then we don't consider the interest expense. So in this case, there is interest of 20%, which you have the evidence for it. So 20% times 20 million, which we get 4 million, plus our depreciation, we get 15,250,000. So we get our 30,600,000 minus 15,250,000. We get our taxable rental income, which is 15,350,000. So since it was a individual income, then we can calculate our tax payable. So our tax payable, as we are using the personal income tax, is from 0 to 360, 0%. From 360 to 1.2, we calculate 20%, which becomes 168. Then from 1.2 to 15, 350, you get 30%, which becomes 4,245,000. So we can add this plus this, we get 4,413,000. And then the member is paying a quarterly payment of 300. So when we are calculating the quarterly payment, we consider 3 quarters because we shall discuss this one in our later video when we are looking at taxation procedures. We look at the three quarters because the first quarter, that is the final declaration. So we don't look at that. We consider that he paid 3 quarters. So we let's get 300 times 3, which gives us 900. So we get our tax liability of 4.413 minus what was paid. Then we get the tax that is supposed to pay. So that is how we consider or we calculate the taxable rental income and the tax payable on the rental income. So that is what we can talk about in our introduction to personal income tax.